Let's remind ourselves once again of the price action in the oil market, and this is where we are standing for both of the global benchmarks. WTI 67.17, Brent 69.45, trading to the downside after OPEC and its allies raised production by 547,000 barrels a day from next month. It's the latest in a series of output accelerations made by 8 members in 2023 that unwinds their previous policy of withholding production and comes amid mounting concern over the possible fate of Russian oil supply and extra allowance being phased in by the United Arab Emirates. Let's talk about this and bring in Amrita Sen, founder and director of research at Energy Aspects. Amrita, great to have you on the programme and welcome.
Thank you.
OPEC's strategy to defend market share didn't work out too well, did it, last time during the Naimi era? Could OPEC risk collapsing the market again? And what then is the logic behind this?
I don't think the logic for OPEC's policy has been market share. I think this is something the media talks about quite a lot, and I have consistently said that we disagree with that line. This particular policy has been about just genuinely equitable share, because you cannot have some members not complying with the cuts and others continuing with it. And I think this is exactly why since April you have seen this slight change in policy. But you also have to think about the condition of the oil market. I mean, everybody came into this year extremely bearish, but if you've seen anything, market has continued to surprise to the upside just how tight it is. So we continue to have extremely strong backwardation, which is a sign that actually inventories are very tight. So it needs the OPEC barrels, right? So this is OPEC being precautious, preemptive, but at the same time, it is actually adding the barrels the market needs. I think for me, yesterday's communique was super important, because it actually talks about all options now being open. They talked about a pause, potentially, bringing back the 1.66, but also saying we can cut back the 2.2 that we've just brought back if fundamentals warrant. I don't think, if you think about it, just the fact that you're asking about market share, if it was about market share, would they not have brought back the entire 2.5 in one go? They didn't, right?
Yes.
They're being very steady and steadfast.
So, in other words, the market can absorb these additional barrels that OPEC plan to bring to put onto the market.
It has been so far. The OPEC Plus has brought back, after September would be the full 2.5 million barrels per day, including the 300 from UAE. And yes, we have absorbed it. Now, exports have not risen by as much as production has. That is because we have seen a significant increase in domestic usage within the Middle East, but also because some of the countries are already maxed out. They cannot produce anymore. And that's why you haven't seen exports go up by as much as production has. Now, let's see what happens from September. Summer burn usually comes down. But even then, I do firmly believe the market is going to start talking about spare capacity sooner than later. And I've already started to see some other analysts kind of suggest that, yes, maybe spare capacity isn't as high as what people were expecting.
Amrita, how then would you characterise global market balances as they stand at the halfway mark of the year? Is it consistent with the market really being that tight? What is the picture looking like in 2026?
Right here, right now, the market is very tight, partly because, yes, we've seen inventory builds this year, but 90% of that has gone into China. Chinese commercial reserves have built because, prices were low and Chinese refiners were filling stocks. Strategic Petroleum Reserve is also going up from July because that's a government mandate to fill 140 million barrels. I was just there in China last week, and I think you can see just how much they are buying of this crude. So if China absorbs a lot of this inventory, that is actually bullish for oil prices, and it keeps commercial inventories at pricing centers low. So you look at Cushing, you look at Northwest Europe, those are very, very tight, and that's why the oil market's been very tight. Like I said, OPEC exports haven't also gone up as much as production, and now, of course, you've got this potential sanctions threat that could reduce Russian and Iranian oil.
Yes, and I'll get into that later, Amrita, with you. However, when you look at last Friday's jobs report, on the softer side, disappointingly so for the markets. Did that tell you that perhaps the global economy is quite precarious? It's at an inflection point, and what if it does inflect lower and there are all these additional barrels on the market? What happens then?
Look, even without the jobs report, our demand outlook has been cautious precisely because of the tariff situation. It is not an environment where companies can grow very quickly, very easily. So I think there is concern about demand growth. Our numbers reflect that. We've got about 800,000 barrels per day of demand growth this year, and just a bit more, closer to 1 million barrels per day next year. So these are not huge numbers. Our balances, like everybody else's, do show a pretty significant increase in inventories, really next year onwards. I mean, this year Q4 as well. But again, if China is buying a lot of this oil, commercial inventories will not build. But I do think the market has been pricing this in, right? If you look at the narrative coming out of the oil market, it has been bearish precisely because of the expectations that we are going to get a pretty significant buildup in inventory from late 25 throughout 2026. The question really is how much, because if stocks are super low now, we do need to build a little bit at least before you start to see that pressure.